Well, Kare, thanks a lot, as always, for the kind introduction. And, from my side, thank you very much for the very warm welcome here in Zurich. Of course, I'm honored to be again invited to speak at Insurance Europe's annual international conference, this time under the patronage of the Swiss insurance market and the Swiss Insurance Association. The connections between the European Union insurance market and the Swiss insurance market are well established, not only due to the fact that they are established by long-standing bilateral agreements or equivalence decisions. We are neighbors, not only in geographical terms, but also, and in particular, in economical terms. The European Union is Switzerland's main trading partner, whereas Switzerland is part of the most important EU trading partners. From an EU perspective, it is indeed the trade and services, in particular commercial services, including insurance, which is the most important. The insurance market in Switzerland is a big market, domestically and globally. And ahead of the conference, I read, according to expectations, that the Swiss insurance sector will overtake the Swiss banking sector in 2018 in terms of its proportion of the national GDP, which, if proven to be true, I think it's a rather impressive statement. The Swiss insurance market is among the 20 largest insurance markets in the world. 3 out of the 20 largest insurance groups in Europe are Swiss companies. And what does it mean for EU legislators and Swiss legislators with regard to the insurance business? Regulating insurance in Europe and regulating insurance in Switzerland results in a better outcome when do it in close cooperation with each other. This is how we may better succeed in achieving a level playing field and in providing our customers across borders with the best available and most attractive products. And indeed, it is our common understanding of risk-based insurance regulation that already brings us closely together. Let us recall that the Swiss solvency test has been introduced in 2011 when the European legislators were still at the roots of amending a pre-crisis Solvency II directive. Now also the European framework, also risk-based and close to market consistency, is successfully applied across the European Union since 1.5 years. In my capacity as the Omnibus II and Solvency II rapporteur of the European Parliament, it is probably not upon me to judge which legislation is a better one. However, being in Zurich today, I could agree saying that the two legislations are equally good. Ladies and gentlemen, the European and the Swiss insurance industry can still operate in prosperous times. However, insurance finds themselves at crossroads since a couple of years. Political and economic and regulatory changes are the main challenges to rethink strategies, business models, and of course, products. Political uncertainties resulting from increasing nationalism worldwide and a reshuffle in the global balance of power could damage the business climate globally and of course in Europe as well. EU insurance companies and British insurers have to face the upcoming negotiations on Brexit, which will have implications on the design of the market access for both markets. And it must probably not be reiterated, but still the historically low long-term interest rates continuously weigh on capital positions and earnings. The effective application and phasing in of Solvency II requirements is a big deal for the EU insurance sector and for EU supervisors across all member states. The implementation of the Insurance Distribution Directive is still due and binds resources. And companies are still in the process of adjusting business processes, risk management, and strategies. It is a fact that the insurance sector has to deal with new and reinforced regulatory requirements, with a tightened supervisory oversight and changing market conditions at the same time. And this is, of course, not a brand new story, but it has consequences. Insurers have to invest in technology to a much greater extent than in the past. First, of course, insurers continue investing in technology that helps to cope with a new regulatory environment. And then second, and even more crucial, insurers have started to invest heavily in new business models based on new technologies and on the broad use of mobile internet and social networks. There are certainly huge business opportunities in big data, digitalized advisory services, new smartphone-based business models. And this is not to be criticized. That companies make use of these opportunities, that they invest in InsurTech to serve modern client demand, that they diversify their business, and that they engage in competition with the result of more dynamic prices and more attractive products to the benefit of the customers. So, no blunt criticism, but a strong concern. The landscape of risks and the risk behavior will change dramatically, and we are already there. Ladies and gentlemen, let us recall the recent example of motor insurers offering discounts based on their customers' social media history, or the example of health insurers offering discounts based on their customers' sports activities and the healthiness of their lifestyle. The boundaries between private data we willingly share, private data we share without being aware, and private data we explicitly do not want to share, these boundaries are almost impossible to set or to control. Not even speaking of the liability issues attached to them. The access to data, the use of data, and the confidentiality of data, the withdrawal of access to data, the system of liability, all these elements have to be rightly assessed, considered, and addressed. And in addition, let's also point to the fact that InsurTech could bring cyber risks in so far unknown ranges. Are the regulators on the basis of existing regulations in an adequate position to deal with the new challenges following the emergence of InsurTech? I'm honest with you, we are not there yet. In recent years, the EU institutions were busy in broadening, strengthening, and adjusting the regulatory framework to changing conditions and to complexity. Having the worst financial and debt crisis in our lively memory, the regulators concentrated on minimizing the risks that were most relevant in the emergence of the crisis, namely the lack of cross-border cooperation among the supervisors, the lack of crisis resilience in the financial sector due to flat-based or soft regulation, then the absence of risk-based capital adequacy and the appropriate risk management tools, and finally, the complexity of financial products and the opacity of the selling practices. The financial markets regulation, the supervisory architecture, the product supervision, everything changed substantially. And is still on its way of being changed. At the same time, we probably paid less attention to new emerging risks. The EU institutions have the ambition to regain lost time. In the European Parliament, we recently took initiative and adopted a non-legislative report on financial technologies. We were the first EU institution to adopt a report asking for the reconsideration of our approach towards innovation and new technologies in the financial service sector. The European Commission is currently developing recommendation and policy measures in special financial technology task force, which is supposed to deliver first results after the pending public consultation has been concluded, but still in the course of this year. And as parliamentarians, we hope to see further progress on this issue soon. We would be ready to work on legislation where new legislation is justified. And at the same time, we recognize that the Commission included FinTech in their 2016 communication on the Capital Markets Union. And we acknowledge that the balance has to be found between regulating and new business sector on the one hand, and promoting dynamic innovation on the other hand. Classically, one would consider a same risks, same rules approach. If this approach is for qualified reasons not feasible for small and innovative startups, it should at least be ensured that customer awareness and customer information are based on equal footing with bigger fintech enterprises. And I'm confident that the European Union will be able to deliver an appropriate framework for the regulation and supervision of fintechs, balancing the need for a level playing field and the need for proportionality, competitiveness, and low entry barriers. In the European Parliament, we are looking forward to an update from the Commission, hoping that the midterm review on the CMU in the course of next week will already provide more clarity on next steps towards a fintech framework. And in this context, let me also reiterate that the European Parliament is also keen to start working on the revision of the regulations of the European supervisory authorities. My personal reminder is no surprise to many of you, given that I was part of the negotiations that led to the establishment of EIOPA, EBA, and ESMA in 2011. A revision of the regulations is overdue, and a revision provides opportunities. Positive opportunities are, in my view, indeed linked to the increasing intensity of innovation in financial services and the growth of the fintech sector. While at the moment national supervisory authorities are very much, and from my point of view, positively engaged in finding appropriate approval procedures for fintechs, it's already obvious that the supervisory fragmentation increases and will create difficulties in the future. We have to avoid that. Divergent intensity and divergent practices of supervision are used as a tool to attract new business. And we have to avoid that positive innovation is offset by inappropriate bureaucracy multiplied by 27. I'm not known as somebody who calls for IOPA easily. And I'm looking, of course, into the direction of Gabriel. But this is where I see capacities for IOPA as a supervisory authority. We need some involvement of IOPA here, potentially some supervisory guidance at European level, and preferably also, I want to add that, on a global level. Aside from the financial markets regulation, which is of course my field of expertise, the European institutions have taken further measures to deal with the increasing emergence of cybersecurity and cybercrime. Last year, the Directive on Security of Network and Information Systems, NIS, has been adopted, which complements the General Data Protection Regulation, the two of them being applied from May 2018 onwards. Member States will be required to adopt a national cyber strategy, and companies have to take appropriate measures to protect themselves against cyber risks. The present EU cybersecurity strategy is scheduled for review in September this year. This review also includes a mandate for the EU Agency for Network and Information Security, the ENISA, which exists since 2004. A continuous progress in improving our data protection rules and our cybersecurity policies is absolutely necessary. Ladies and gentlemen, I have outlined that the European Union is active on all different angles related to the opportunities and concerns around increasing digitalization in financial services. And it is a challenging endeavor. Responsibilities are currently still fragmented. Many different authorities are involved, even within the institutions. We have different departments and committees working on making the European Union fitter than before for the age of digitalization. And it will be crucial that we manage to coordinate our efforts successfully in the institutions with the relevant international partners and organizations, the private sector, and of course, the civil society. However, it would be too simple to put the burden on the legislators and regulators alone. Naturally, innovation is quicker than legislators and regulators could ever be. This is why I'm personally favorable in a favorable use of digitalization to the benefit of the economy and the society. And it depends as well on the cooperation and the proactivity of the industry. To conclude, I want to give you, I think it's quite a good quote here from the former director of the FBI, Robert Mueller, who became again prominent in these days. He gave in March 2012 his famous quote when he said, "I'm convinced that there are only two types of companies, those that have been hacked and those that will be. And even they are converging into one category, companies that have been hacked and will be hacked again." I know it's a drastic statement. However, it reiterates part of my message. In our approach to foster the positive use of digitalization and to minimize the negative use of digitalization, we all have to deliver. It is no finger pointing to one or the other side. We all have to do our job, and possibly more intense than before. Thank you very much for your attention, and all the best for this conference.